Well, hello, everyone. Welcome to Trading Price Patterns. My name is Barbara Armstrong. I'm a coach with Schwab and delighted to have this chance to spend a little time with you to talk trading price patterns. So I know a lot of you are probably sitting with a bottle of Tums at your desk. There's been a lot of commotion in the markets. There's been a lot of commotion in the world politically this week with tariffs with a capital T being, the talk of the day. So today we're going to talk about support. We're going to talk about resistance because this is trading price patterns. So support and resistance and bounces and breaks. We're going to look at things that are moving bullishly and we're going to look at things that are moving bearishly. So we're looking at bounces and breaks and support and resistance. So that's what's on the menu for today. We have the fantastic Mr. James Boyd with us riding shotgun in the chat. He is such an expert on the markets. I love when I get to be in the chat for his classes because I learn something from him every time I get to, sit at his feet, so to speak, through one of these webcasts. So if you've got questions, don't hesitate to ask. And also, James will be teaching this afternoon, so you'll want to be sure you don't miss that. We've got a lot of people who help bring this class to life, as some of them are behind the scenes that we don't see, but we've got a lot of people in the chat, who were contributing before the class even started. So hello to John and Sharon and Greg and Jay and Villager and Life in the Fast Lane. Love some of these handles. And Bob and Ocean Life and Scott and Truth Will Always Prevail and the rest of the gang. Thank you all for being here. Know that, before we get out to the charts, I just want to reemphasize that we're using the Paper Money software application on the Thinkorswim desktop platform, which is a great place to learn and hone your trading skills before you consider trading in your live account. We will discuss some option trades today and know that options carry a high level of risk and aren't suitable for all investors. And while our focus, given this class is called Trading Price Patterns, is technical analysis, other approaches, including fundamental analysis, being aware of the news, earnings reports, and all of that good stuff helps us make more informed decisions, right? Right. Okay. One of the differences between Paper Money and a live account is that short options will never be assigned early. In Paper Money, that can happen in a live account. Okay. So, one quick announcement, and then we're going to do a very limited market overview because Kevin Horner does such a beautiful job of that when the markets open at 9:30 Eastern. James will be covering that class tomorrow. And I think because Kevin is heading for Scottsdale, James will be handling it on Friday. And I think maybe Brent is covering it for him tomorrow. So there's that. Anyway, we're going to focus a lot on having a look at different setups. We're going to play some new example trades, and that will be our focus more today as opposed to trade management, which we'll focus more on Friday. Okay, so announcement. If you have never been to a live event, they are really wonderfully done events. Kevin Horner will be at the one in Scottsdale this weekend. So if you're going, I'm sure Kevin would love the opportunity to meet you. Please go up and introduce yourself. And then I will be at the Chicago event, March 21st and 22nd. That is an advanced options event. And we haven't done a lot of those in the last 5 years. So I think registration is close to closing. If you want to go, get the registered PDQ or you'll miss out. I mean, they won't turn you away at the door, but they like to plan for their numbers. Okay, so let's get out and have a look at the market. Just bring this up. We may or may not be looking at Marvel today, but if we come and look, let me just get rid of this altogether for the moment, at the S&P 500. Although we now have this, what appears to be a bullish engulfing pattern here after yesterday's commotion, when I first looked at this morning, it was, another down day. And, Chicken Little is now officially out kind of running around, and this market is down, 5.5%. It, hit a low of 6.7 yesterday. And so people are concerned, and we're seeing a lot of kind of whipsawing going on. And the NASDAQ, I heard some of the, there were those in that look at the market saying this is officially correction territory. At one point, it was down 9.65, still down 7.3, so Chicken Little is out there running around. But, might this have been a temporary scare, or might this go back into the range it's been trading in since December? It might, but, we don't know. But what we do know is that volatility is sitting at levels we have rarely seen in the last year. I mean, even with today's pullback, it's at 22.6. And so what does that mean? Well, what it can mean for some investors is opportunity. An opportunity to do what? Well, opportunity to sell perhaps something. And why would we want to sell? Well, if we sell an option when volatility is high, and then volatility kind of comes back down in the market, breathes a sigh of relief, if that happens, then, volatility will come down and those options that we've sold might come down in value. And, it's kind of the opposite of when you buy a stock and you want it to go up. When you sell an option, we want the value typically to go down, don't we? We do. Okay, so let's look at some things that are messing with support and resistance levels. So let's look at CSX. So CSX, and if you're not familiar with this company, it's part of the industrial sector, right? Rail-based freight transportation services. And this broke below this support level yesterday and appears to be continuing to fall today. And so, how might a trader look at that? Well, they might look at that and say, hey, is there an opportunity here to do a short call vertical, or might this downtrend continue? We could look at that. How about American Express? Well, this is just a 6-month chart. But if we make this a 1-year chart, this has come down and kissed, flirted with back at the end of July, the 100-day moving average. But it has basically spent very little time below it. And it yesterday broke below that 100-day moving average. It was flirting here for a few days, and then it just kind of dove out the window. Now, today we have this hammer type pattern setting up. It's still a live candle, so who knows where we'll be by the end of the day. But, we also had a support level here around the 292 mark that this had hung on to, and it's broken below that as well. We may also want to keep our eye on Salesforce. And Salesforce, was uptrending, and then it kind of consolidated. Some might say this might be kind of a sloppy double top. And we were looking at this in our flag pattern discussion yesterday. So I'll just get rid of these so that they're less annoying, but we're seeing now, a set of bearer flags setting up on this. And this too has broken below a support level, came back to retest. So old support becoming new resistance, old floor becoming a new ceiling. And could this be another day where the bulls might win, but the bears, the bulls may win this, this particular point, but it looks like they may still be losing the match. Okay. Oh, John is asking, can you remind me what the 3 moving average lines are? Now, if you look at the top of the chart here, it says simple moving average in blue, and that's the 10. So the blue is the 10, the red is the 30, and the black is the 100. Okay. So that's what those 3 lines are. How about if we've looked at CSX, how about we look at CVX? And here's a different type of support level, right? This is a diagonal support level that was established, starting in December, and running through, well, Friday on March 3rd, it looked like it was breaching that support level. In addition, like in one day, it blew through the 10, the 30, and the 100. Like that's an overachieving, red candle, isn't it? And then yesterday's candle, it opened low, closed higher than it opened, but it was still a down day, and today continuing to the downside. So might some traders look at this and see an opportunity to perhaps do a swing trade and say, hey, what if I bought a put and said, hey, when it gets down to this 140 level, I'd sell it. Yeah. So that's CVX. How about Goldman Sachs? The financial stocks, they've taken some tough hits. And yesterday, Friday, Monday and Tuesday, this crossed that 100-day moving average. And today we have a Harami pattern indicating maybe, it's finding a support level. But with everything that's going on internationally, some might say, I'd like to see confirmation that this pullback to the 100-day moving average is complete before I, commit to a trade one way or the other. Let's say we're out of that one too. Okay, so that was Goldman Sachs. IBM. So with IBM, could this be a potential bounce? Could this be a situation where it gapped up on the last earnings, and then it's really held this baseline of around that 240 to 250? It went up, came back to retest, went up again, came back to retest, and it spent 4 days hanging out here. And so if you were a more aggressive trader, yesterday when the market was tanking, this stock was actually up. You might look at saying, well, could I maybe sell a short put vertical, maybe around that 245-ish level? And then some traders might say, yeah, I want to wait and just see some more confirmation that this level is holding. I want to see a bullish candle on this. Now, what's the advantage of placing the trade today is that if in fact this support level holds, chances are you'll get a little more premium. Like if we came out here and it does trade more than 1 million shares a day, and we came out to that, we wanted to be, let's see if we could do the 245. We've only got 34 contracts, but a 20-cent bid-ask spread and over 100 contracts here. So we'd get $1.50 and be risking $3.50. And so if we looked at that, that would certainly meet our return on risk requirements of about 40%. Well, 42.8 if you want to be particular on a 23-day trade. But some people, Tums bottle at their side, and that isn't to say, that's an excuse, but it may be a reason to pause when there's more volatility in the market. Yeah, so you can put timings in on your exits. So somebody's asking a question about that, and that is possible. I'm not going to go through that today, but it is possible. And I think if you look at the Brent Moores taught a Thinkorswim class, I'm sure that he covered that in there. I'll see if I can find it and I'll post it on X. So with JP Morgan, we've now come down to the 100-day moving average for the first, second, third time in the last 6 months. And this appears to be holding. But we've got two bearish candles here. And we had a diagonal support level here. And it just blew right through that yesterday and hasn't quite made its way back yet. So a conservative trader might say, I'm going to wait until I have some confirmation that this support level doesn't start acting like a ceiling. Okay. Now, how about Mark? Okay, so with Merck, here's a case where we had a support level, and it came and it hit that support level. Let me just grab my drawing tool. Oops. I was recording a little mini session on hammers, so tell that was my last. That was my last. So, we had this 95-ish level acting as a support level. And now it doesn't seem to be able to get back up above. So it gapped down on earnings, came, not quite close, came up to what, maybe 92.50, came and almost kissed it here yesterday. And then seems to be moving again to the downside. So could we do something at 95 and do a short call vertical? Now, this is an intermediate level class, and I'm assuming you understand basic option strategies, but for those who may be new, a short call vertical, we're selling a call on a stock we don't necessarily own. And then we're buying a call to define our risk because our expectation is that the stock is going to continue to trade below 95. Okay. So if we did that, let me just close this, come back. So if we come to our trade tab and we say, okay, we want it to be above 95. So if we come to the 95, we have a 31% chance of this being in the money. Come expiration, we have a 60% chance that it might come up and hit that at some point between now and then. This trades over 1 million shares a day. There is an example trading plan in the Trade Management mini session collection. So you are welcome to go and view that at your discretion. So if we did a $2 wide spread here, we'd get 50 cents. And so how much are we risking? Well, if we come here and switch this to a calculator, we say, okay, if we can make 50 and we're risking $1.50 or $2 minus the 50 cents, that's about a 33% return on our risk. And we're in this for how long? 23 days. And so we want to get at least a 23% return just to try and make it a rule of, a rule of thumb. If we're in it for 40 days, we'd want a 40% return on our risk. And you can make your return on risk goal whatever you want it to be. That's just what we decided in our example trading plan. So if we're risking $1.50, if our max risk is $500, we could do 3 of these and we'd be risking about $450. So if we come to confirm and send, we can see that our break even is 95.49. And this is actually a bearish to neutral trade. So this could go up by $3 and we'd still be okay. So what this is saying, that would be our break even. The most we can make is 147 and our max loss is 453. And we're going to put an exit in, and we may decide if we meet on Friday and we've already got half our max gain, might we change our mind and say, hey, we don't need 80%, 50%, given everything that's going on is fine. So we're going to make this 10 cents. But subject to exiting, at our discretion. And we're going to put that in our short call vertical group. Okay. And this is a weekly. So we're out 23 days and we have lots of volume on these contracts, but typically less volume than the monthly contracts. Okay. So there's our first trade. Now, how about we have a little peek at AMAT? Okay. Yeah, so somebody's asking, I'm just looking at the questions. Is that a cup and handle on, was that on Merck? MRK? Well, it could be a cup and handle, but it's a very short time frame. It's just about a month. And some technicians like to see patterns that develop over a slightly longer period of time, and it hasn't broken above. And so, but you know what? It looks cup and handle-ish, doesn't it? Okay. So let's go on to AMAT. And then I did reference a couple of trading plans. And so let me just take a second here to bring up the Trader Talks from Schwab Coaching. And this is where, I insert commercial here. If you haven't subscribed to the channel, there is a subscribe button in the bottom right corner. And so you'll want to hit that subscribe button so that you can easily find this. I had somebody put in the comment section that they had watched a class and loved it and then couldn't remember my name, and it took them 3 months to find me again. So avoid that kind of frustration. So what comes up first is whatever is currently being taught. If you go to playlists and scroll down, you're looking for a pink, we call this a thumbnail, and it's the trade management mini sessions. And if you haven't watched these 2 short videos on the power of compounding, I encourage you to do that and then share them with friends and family and neighbors and such, because I think it's a pretty powerful message. And here are these example trading plans. So there's a long put vertical trading plan example, and we're going to talk about tweaking that a little bit today. And then there's, here's the short call vertical based on the trade we just did. And we may do a short put vertical trade also. So, I have a lot still to add, but there's, 7 of them in there now. Okay. And I know that if one person is asking, there are probably several people asking. So with AMAT, here we had, a stock that was consolidating, right? And it now has broken below this support level, came back, bonked its head on previous support. So it's looking like maybe new resistance. And then we have a couple of hammer patterns here or dojis where, the bulls and the bears are duking it out, and they've driven the price up and they've driven the price down. But at the end of the day, it ended pretty close to where it started. And it looks like we have a similar candle happening today, although the day is still, not over. So this candle could look dramatically different. But if we're looking at this and thinking, hey, I think this downtrend, which started here on January 22nd, and we've seen, if we want to get technical, and this is a technical class, we had it come down and then rally for 3 days, come down, rally for all of 1 day, come big down day, 1 day rally, and down again. So could these be contributing to a bear flag? Now, you may want to wait for that close below the low of the high day to place a directional bearish trade. But if you're trying to take advantage of proximity and volatility being high, could we come and do another one of those short call verticals around this 160, maybe 165, where we're selling the 160, and then to define our risk, we're buying the 165. Okay. Okay, well, let's go have a look. So let me just close that. So if we come to AMAT, and if we're saying, if we come out 3 weeks, what's the advantage? Well, the advantage of coming out 3 weeks, and I want to be at 160 here. I was looking at a long put vertical on this one, but the candles changed because it was pretty dramatically down when I first looked at this a couple of hours ago. But yeah, so if we're looking at this 160, does it trade more than 1 million shares a day? Check. Do we have at least 20 times the number of contracts we're thinking of trading? check. If we look at this expiration date, time decay will work at an accelerated rate because we're only 3 weeks from expiration. But if the trade goes against us, we have less time to recover. So there's always a yin and a yang with these things, right? There's no totally free lunch. So we're looking at this 160. Then the next question is, can we get enough juice to make it worth the squeeze? So the most we can make is 155, which means how much could we lose? 5 minus 155 or 355. So if I say we can make 155, I'm going to divide that by 355. Sounds a lot like 30% to me. Well, I was wrong. It's almost 44%. And so if we say, okay, and what's our probability? 33% chance of it being in the money. You know, a 68% chance that it could come up and kiss it, but that means we've got a 67% chance that it could expire worthless. And how many of these are we going to do? Well, we're risking 350, so we're only going to do one. And although we're putting this in up front, can we change our mind and exit earlier? Absolutely. In fact, we did that in a couple of trades on Monday. We're going to say, hey, when we've got 80% of our max gain, we'd like to take our risk off the table. And so we're going to put that one in our short call vertical bucket also. And if you're wondering how to set up these groups on your monitor tab, if you scroll down past the trading plan, there's a whole group of short Thinkorswim videos on how to customize your charts in the monitor tab and all that good stuff as well. Okay. You know, now not everything is doom and gloom. So let's look at a couple of things on the brighter side of the street. So one of them might be Triple M. So when we look at Triple M, we had a short put vertical on Triple M that we ended up out of on Monday. So 2 days ago, it came up, and you know, just after we ended up out of that trade, and that one worked out well. But could we do a wash, rinse, repeat and say, okay, that trade is now done, but it's come down to this support level that it's been at once, twice, 3 times a lady, 4 times, you know, and now we have this candle pattern, this Harami candle pattern. And is it a guarantee? Yeah, there are no guarantees. But, you know, the last time we had this Harami type pattern, it worked out. And this one might work out and it might not. But could we kind of do the same thing with a further out expiration date? The same strikes, this 145, 140. And so the expectation here is, again, you know, it's kind of, we've flipped it and reversed it. Now, instead of selling a call, we'd be selling a put because we're expecting it to stay above. And then we're buying a put to define our risk. Okay, and that's a short put vertical. And again, there's a trading plan in there, an example trading plan that you can customize or just kind of use as a framework to create your own plan. So if we look at this, could we come out now instead of the 21st to the 23rd? And, you know, when we look at these, we wanted the 145. So we've got 73 strikes or 73 contracts, over 1 million shares traded. Bid-ask spread is about 20 cents. So that meets our criteria. So could we sell a vertical? And it will put in the closest strike to it that it can find. But could we come out to the 140? And again, if we get 143, 144, that's got to be that 35 to low 40s. So 144 divided by 356, I think. So that's about a 40% potential return on risk. So single order, first trigger sequence, right click, opposite order. If we say, hey, when this is worth about 29 cents. Now, some people like to put in a 90% number. Some people like to let it expire worthless. There are reasons why we choose not to do that as part of our example trading plan. because you don't want to risk ending up with at expiration with it in between the strikes and end up, buying a bunch of shares that you may not have the money to buy. Okay. So we're going to put this in our short put vertical group. Okay. So that's triple M. And we got filled on that. And so if we want to see this on the chart, we can just kind of come back in here, edit it, and change the date. So this probability number on the chart, and you guys have been keeping James busy, but this probability of it being in the money is based on where the strike is in relation to the stock. And so, and it's also based on time and volatility, is my understanding. And these are fluid numbers. I mean, you can be watching this and see them change. And if the stock moves dramatically one way or the other, we can see these numbers change as well. Okay. Let's look at Lilly also. So Lilly, and if you're not familiar with this company and you're just saying, like, what sector is that even in? Well, it's in the healthcare sector. And, so when we look at the charts, if we bring up our sectors, how has our healthcare sector been doing? Well, it's set up this like inverted head and shoulders pattern, and it's flirting with breaking out, isn't it? So we've seen, a number of stocks that are bullish in this category as, some investors are looking for safe places. And when we look at the last month, we're seeing all of a sudden real estate, at consumer staples, healthcare coming up, and utilities, although utilities down the last week or so, but consumer staples, you may not have to, buy a new car, but you got to buy toilet paper. So a lot of these companies in the staples sector are doing fairly well. Okay, so if we look at going back to our Lilly, so we had this double bottom pattern, right, from 723 to 847. So that's 100 and some points. If we're looking at this range, it broke out, came back to retest, and has been, in spite of all the shenanigans happening with markets and tariffs, this one seems to just be trucking on up the road. And so we had a pullback yesterday, moving to the upside today. So could we look at this and say it's trading at 915? And if we come in a little closer, 2 days ago, it was at 929. So could we come in and do 915 and 920? Now, if we come out to April, which gives us more time, could we do we could do the 910 and the 920, and it's already halfway there. So if we look at this, and we've got lots of contract, lots of volumes. So if we're looking at lots of volume, we're looking at paying 533. And if you look at the example trading plan on this, our example trading plan has been our target of making 50%. So we'd be looking to get out when this was up about, at about 750 or 780. But what if we said, with all this crazy volatility in the market, maybe what we'd prefer to do is lower our sights a little and say, hey, if we're up 25%, we'd be happy campers. So if we look at this and say, okay, 525 times 1.25, if we got out, how about we put in a target of, if this goes up to 656, we would like to exit. And so we're just going to go with a more modest target, just because of the volatility. and just see how that plays out. So we're going to make this 656. Confirm and send. And this is saying, how much could we lose? Well, when we buy a vertical, we could lose all of it. And how much could we make? 467. We're saying, hey, if we can make a 25% return, we'll be happy. So we're going to put that in our long call vertical group and say target is 25% versus the 50. Okay. Okay, so there's a couple of other stocks that, I just want you guys to kind of keep in mind. So one is Travelers. And do you see kind of a similar type of pattern here? So this is insurance. If you click on the analyze, it's part of the financial sector. So it's, commercial and personal property and casualty insurance. And we saw, this get kind of hit, but I'm not sure if this is one of the ones I recently posted on X, and some might call that a double bottom. Some might say, well, you say double bottom, I say cup and handle. And it's like tomato. It's not a little handle, but, we've gone from 231-ish to 252. So we've got a range here of about $21, which, some might say, well, then my target on this, I would add $21 to that 252 and make my target around 273. And so if you had an account where you'd be okay with owning shares, could you add this to your portfolio and put a target of around 273? Now you might say, well, it's at 256. The previous high was 269. Maybe I don't want to be greedy because it's got up to this 269, 270-ish level. Could we make the target 270? Sure, we could make it whatever we want. Now, could we also do this with a call? We could. We could. So let me shake my Etch-a-Sketch here. And then we'll have to wrap. But we can't afford to buy. We could buy a few shares and put in a target of 270 in our smaller account. And so we could do that, or could we buy a call? Now, what's the advantage of buying the call? Well, the advantage of buying the call is we're putting out a lot less money. But calls come with expiration dates. And if the stock doesn't move, let's say, by the end of April, it's still trading around the same price. The stock, you won't have made anything, but you won't have lost anything either. But the call, if it hasn't moved in the direction we're expecting, then we could lose all of it. And so that's the difference. So if we come to the trade tab and we say, okay, if we're looking at April, we've got 43 days, but this could take a while to get there. Now, we don't have another option available to us until we get out to July. So it's either April, May, and June aren't up yet and won't be available until March closes. So this has only monthly options. And so, if we look at this and we say, it could get up to this 270. I mean, in an average day, this moves $5, about $5 a day. So it could move that far in 3 days. But it could also take 3 weeks. And then time decay is going to be, nipping at our heels. And so with this one, when we look at our choices, we might just say, you know what, I'm going to go with the stock option instead, even if I'm just buying a few shares. So if I say, okay, I could buy $5,000 worth of stock, and I'm going to divide that by 257. So I could buy 19 shares. Okay, so if I buy 19 shares, I'm going to buy custom with an OCO bracket. I'm going to put in my target of 270. And make that good till canceled. And then where might we put a stop? Well, we might say this was acting as support around this 252. So if I took 252 and we put it 3% below that, that would be at 244. And if it comes back down into this range, it's not going in the direction we were expecting. So we're going to make this 244.44. You'd almost think I planned that, but I did not. And we're going to make that good till canceled. And so we're saying, you know, if it goes up $13, we'd like to exit, take the money and run. If it goes down by $12.50, and it's $12.50 times 20. So, you know, if we look at that, you know, we're risking about $250. Now, there's no guarantee that we'll get out at either exactly the target or exactly the stop. So, you know, we have to keep that in mind, but we're willing to risk $500 on any one trade. So this is based on our cup and handle breakout target. There we go. Whoa, it may not. It's saying I have to wait till tomorrow. So, you know, I'll make sure that we put this one in. Okay. Let me just look. Okay. So let's review what we've done. Well, we tried to put a stock position in on Travelers. We did a long call vertical on Lilly. So we spent a little time hugging the bulls. And we also did a short put vertical on Triple M, which was a bullish to neutral strategy. And then on the bearish, on the bearish side, we did a trade on Merck, where we were expecting, or bearish to neutral, if you will, this to stay below. So we looked at 4 different positions today. Oh, I had 100 on Travelers. That's why. Okay. So I'll go in and put that in because we're now out of time. But thank you for catching that. Yes, it was supposed to be 19 shares, not 100 shares. So yeah, takes a village, right? See ya. And thanks, Rob. Rob caught that. And Skylo. Oh, you guys, and Frankie. You see, I was the last one to figure it out. Okay. Well, guys, that's a wrap. I want to thank James for his work in the chat, the guys behind the scenes for their efforts in helping bring this class to life. Please hit the like button if you haven't done so already. It helps move this up in the algorithm so that more people can find this content. It also lets James and I know that you thought this was a valuable class, and subscribe to the channel. Don't forget to hit that button in the bottom right corner. And last but not least, follow us in the land of X, James Boyd CS and Barb Armstrong CS. So be there, be square, enjoy the rest of your day, and I will see you in a webcast coming up soon. Take care, everyone. Bye for now.